Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Hello, my name is John Silvis, Chief Investment Officer at Fairport Wealth. In this edition of the Fairport Flash, we are going to give you our current views on the markets, the economy, and what we are seeing as we head into the end of the year. So let's get started. Equity markets continue to grind higher as we head into the end of 2019. Large caps, represented by the S&P 500 index, returned over 23% through October, while the MSCI ACWI, or the All-Country World Index, registered over 19%. Overall, you could say diversification hasn't done well in 2019. While positive, small, mid, and international equities have all trailed the S&P 500. The good news is we should continue to see a tailwind into the end of the year. According to Ned Davis Research, November, December, January tends to be the best 3-month period of the year, and November has gotten off to a pretty good start. The stock market, represented by the S&P 500 index, has finished the day at a high 22 times this year, another sign of market strength. In fact, according to Strategas Research, when you finish the first 10 months through October in a top decile, or 10% of returns on a historical basis going back to 1950, the final 2 months of the year have above average returns with the median return of nearly 6% for the final 2 months. So we would expect strength into the year end with the possibility of further highs in the markets in the coming weeks. One of the reasons for the positive direction in the markets has been better than expected earnings so far this year. Third quarter earnings are looking flat versus last year, with about 93% of the S&P 500 companies reporting. But we would expect to see better growth in the fourth quarter of this year and also heading into 2020. The economy is showing signs of rebounding heading into 2020 as well. Evercore ISI, which has one of the highest rated economic teams on Wall Street, recently raised their 2020 GDP forecast, or estimates, from 1.8% to 2.5% for next year. One of the inputs they use in their model is their proprietary company surveys. They go out and survey over 350 companies on how their sales are doing, giving a reading of 0 to 100, with 50 being about expected. The readings so far have gone up over the last few weeks and currently are at 53.6, which correlates to about a 2.5% GDP growth for the next 12 months. Another area of the domestic economy, the housing market, remains strong. Housing starts in October equaled about 1.3 million on an annualized basis, one of the highest readings since the financial crisis. This is important because housings tend to weaken significantly before the start of a recession, so we don't think there's really any signs of a recession in the near future. Another point, building permits, another sign that the housing market is solid, climbed 5% year over year in the month of October as well. Overall, we think the consumer, which is about 70% of the economy, and the economy in general, are in good shape as we enter the holiday season, with household net worth at a new high. Rising consumer net worth historically translates into better holiday sales, and combine that with the low unemployment rates, sets up pretty well for the holiday season. So shifting to fixed income. The fixed income assets have also done well so far this year, with the benchmark Bloomberg Barclays Aggregate Bond Index up 8.8% so far through October. The yield curve, which was a concern a few months ago, has steepened as the Fed cut rates 3 times this year, with the most recent being in October. We do not expect them to cut rates again this year. They do have one more meeting in December, but Chairman Powell has reiterated that going forward, any rate cuts will be much more data dependent, and so far the data does not warrant further cuts. Ned Davis Research recently pointed out that 13 out of the last 15 times the Fed cut rates 3 times, the market was up a year later, on average about 14.7%. So overall, rate cuts have been a positive for equity markets historically, and so far that has worked out in 2019. Lastly, on rates, Strategas Research has found when interest rates, and we'll use the 10-year Treasury rate, fall 50% or more as they did last year into this year, rates tend to rebound. So we could see a slight increase in rates in the months ahead, but at the very least, most likely we put a bottom in the intermediate term. Finally, we get a lot of questions from clients recently about impeachment and the upcoming election. So according to the policy team for Strategas Research, which is headquartered out of Washington, D.C., they put odds about 85% that the president will be impeached by the House of Representatives, but they only put about a 10% chance that he gets convicted. If that's the case, I'd argue that the markets have already factored that in. Overall, support for impeachment is starting to wane a little bit, with the most recent reading about 46% in favor. At this point, we don't think there's much concern on Wall Street for now. As far as the primaries are concerned, it's way too early to crown a victor at this point. The betting odds, which have actually been more accurate than the polling data, have Senator Warren at a slight favorite with 28%, followed by Vice President Biden at 24%. As a frontrunner emerges in the spring, the markets will probably take much more notice. We would expect more volatility as the primary season kicks off or kicks into high gear, but I think it's important to point out that election years tend to be positive overall, but do have much more volatility during the election season. So as we head into the end of the year, we have been keeping an eye on the direction of the US dollar. It looks to have peaked in mid-September, and any signs of dollar weakness should be an indication of the global economy picking up. It could also be a foreshadowing for better equity returns overseas as their economies continue to improve. This brings us to the conclusion of this edition of the Fairport Flash. As always, our goal at Fairport Wealth is inspiring families, and as a member of the investment team, we strive to do that through a long-term diversified approach. If you would like to discuss any of the topics in more detail, please reach out to your Fairport advisor.